Hello, everyone. This is Umar Khan, founder of Boardwalk Wealth. So in this video, we're going to talk about floating rates, debt, and specifically, how do interest rate cap costs work? Like what is the math behind them? Why are they important? How do people look at it? All that jazz. And to do that, what I'm going to do now is just share my screen, and I'm going to share publicly available resources. So what this basically means is that you can publicly access this information. You don't need an extra special feed, or you don't need to pay for a subscription. So basically, what we're going to be talking about is forward curves. And I'm going to get into what they mean. How do they work for us? How do they not work? What's the math behind it? So I am going to Chatham Financial's website. They have this under tools and technology, and you can go to the forward rate curve, right? So there's a button here called download. Let me download this, and it's going to open up something. Let me actually share this. And what you're now going to see basically is the market projection, right? I'm not going to go into all of these details about these various tabs. I'm just going to hide them. And then I'm going to show you what we really are looking at. So basically what I want you to do is I want you to focus on this graph, right? So this graph basically that you see here has the various rates that are floating rate, or they're also called reference rates. So think about it this way. If you're, say, the United States government, right, you can get a loan at X%, and because you are a really great debtor, because essentially in this case, you have the ability to print money in the currency that is the reserve currency of the world. Other people, like for instance, you and me, we do not have that luxury. As an example, if we ever need money, we either have to work harder at our jobs, create more business, more opportunities for people, and in exchange, people pay us money. Well, the United States government doesn't necessarily have to do that, because they can just theoretically print money, the US dollars, and literally money just falls from the sky. So in this case, they are considered the best debtor on the planet. So they get the cheapest possible rate. And everybody who is not the United States government gets a rate, which is, say, the reference rate. In this case, it could be the LIBOR, SOFR, the Treasury forward curve, and then you add a little spread on top. And I'm going to get to what that means. But for the context of this thing, if you look at this curve over here, what it basically tells you is that on the front end of the curve, which is basically this earlier section, right, the left-hand section, you see that rates are spiking up. And why are they spiking up? Because the forward curve. So now the forward curve in this case, if you see over here, and I'm coming over here, right? This is an example of 1 month USD LIBOR, there's SOFR and 3 months SOFR and all of that. We'll just focus on, say, the 1 month USD LIBOR, or the 1 month term SOFR. These are the most common reference rates or floating rates upon which a lot of the commercial real estate deals are, basically the loans are done, right? So what this basically is the market's estimation all the way out from, say, 10/27/2022 in this case, and it gets updated every day, all the way to 10/27/2032. So over a 10-year period, this is the market's expectation every month of what this reference rate would be, right? This is the reference rate upon which another premium will be added, and now you will find your total interest rate for that month. Now, you just have to remember what typically happens is that this forward curve, this is the market's expectation, and this is what our lenders use, what our rate cap providers use. I'm going to get into that in a second, and all other counterparties use when they're trying to price a loan. And what does pricing a loan mean? Pricing a loan means that, say, when you and I or any other real estate sponsor or investor wants to go to the market, so we've got this great deal. Let's assume it's in Atlanta. It's a value add deal. We want to get a loan on this deal. We will now go to our loan broker or our loan contacts. They will go out into the open market, and they'll come back and say, hey, based on this asset, based on the vintage, location, underwriting, and a bunch of other factors, here is what the market or different lenders in the market are saying. Here's what we will give you a loan on. What are the terms we will give you a loan on? And those lenders are, assuming if they use LIBOR or SOFR in this particular case, they are using some version of the forward curve to get an expectation. Hey, if I'm going to give this person a loan for 10 years in this case, see, start at 10/20/22, all the way down to 10/27/2032. If I'm going to give a loan for 10 years, how much do I expect the interest rate, the reference interest rate, which is LIBOR or SOFR, to be per month? Right now, just remember that the forward curve is merely the market's expectation. A lot of people think there is like some there's only science behind this thing, right? This is a combination of art and science. This is the market's expectation. And you have to realize this is quite a conundrum here, because pretty much all the floating rate loans are calculated on some version of a reference rate. We've just chosen LIBOR and SOFR in this particular case. But this is also a reflection of market sentiment. And as you know, with the stock market, either people assume that things are always going to be rosy, trees are going to go to the sky forever, or the world is ending and things are going to collapse. So more often than not, in fact, in the vast majority of cases, what happens typically is that the market either overshoots, which means that they're overly negative or overly positive. There's only extremes in this case, right? Because this is human behavior. Or they undershoot, which means they're either they're way less optimistic about the future, or way less pessimistic. In fact, things can get much worse, or things could be much better, but we're over and undershooting. And that is a conundrum. So much of the business is done on these forward curves, which happen to be wrong most of the time, but this is the only approximation of the future we have, our lenders have, our counterparties have. So unfortunately, even though this is an approximation of the future, this is basically how a lot of business is done. It sounds really weird that in 2022, we don't have this down to a science, but this is why these industries are ever evolving, and this is why this is not such an easy industry as pressing a couple of buttons, attending a YouTube seminar, going to, say, a mentorship group, and boom, you're done. And this is why also managers like ourselves were paid a very hefty amount of money, because essentially we have to take a calculated, educated guess, given our past experiences, given our performance, given the underlying characteristics of the deal we're buying, the submarkets we're looking at, the demographics we're analyzing, to come up with an approximation to understand, hey, is my version of the future, what is my take on the future? Like, how do I view it? Do I think, say, people are being too optimistic now? And the time right now is everybody's taking very risky behavior, and now it's time for me as a manager to be more conservative. And conversely, when the sky is falling and people think, oh, things are always going to be bad and there are deals everywhere, is that the time to become aggressive? So just wanted to explain how these things work. They're not an exact science. It's a combination of art and science, but this is how these things work. They're not 100% accurate. In fact, most of the time they're inaccurate, but this is the only approximation of the market sentiment of the future. And this is what our counterparty use, and in effect, we have to use. Now, that being said, if we come back to this chart over here, right, to the left, so I'm on this chart. Now, think about it this way. If somebody comes to you and says, hey, I want to get a loan from you for 10 years, versus somebody, exact same person, exact same characteristics, exact same character, quality of credit, and all the rest of the 2Cs, right, in credit analysis. If both two exactly similar people come, and one person says, I want to get a loan from you for 1 year, versus another person says, I want to get a loan from you for 10 years, typically, the person who gets a loan for 1 year in normal, quote unquote, normal circumstances, most lenders will charge a lower rate for a person, and this is an example, right, that they will lend the money out for 1 year versus 10 years. And the reason for this is because there are less unknowns in 1 year, right? Whereas so many things can happen in 10 years. There's so much uncertainty. So many things can go awry. I mean, think about it this way, right? 2012, might as well have been a different century. And that's only 10 years ago, right? So many things have changed in 10 years. Whereas if you're out right now and you've got to go forward 1 year, there's less unknowns, right? There's less risk involved. So typically what you see is, say, a 1 year or shorter term loan has a lower interest rate, and a longer term loan has a higher interest rate. There's a lot of other reasons behind it, but the big underlying theory is more things can go wrong in the long term. So a lender has to be compensated for the risk they are taking in placing funds with or entrusting their funds with somebody versus somebody exact same type of person or character for 1 year or say less than 10 years, right? But what we see here is the exact opposite happening. You can see that there is a huge spike over here. And then rates, at least if you're following, say, this 1 month USD LIBOR, they just start going down. And you start thinking to yourself, well, what does this mean? And this is an example of an inverted yield curve, where in this particular scenario, if somebody comes to you in this theoretical scenario, two people exactly alike in every single way, character, credit quality, you name it, right? They come to you, are going to charge the person who, say, as an example, wants to take a loan for 1 year, way more money. You can see this right at the extreme left of this chart, versus somebody who wants to take money for a much longer period of time. You're going to charge them way less money. And you would think, well, this defies common sense. How is this even possible? And why this is possible is because what the Fed has done is, the Fed has a very supply-centric view of the world. So the way they look at it is they only control, one aspect of policy. That is the monetary policy, right? The actual government controls fiscal policy. So in the case of monetary policy, all the Fed, again, gross oversimplification, what the Fed basically does or can affect is the price of money, which then basically affects the supply of money, and which in effect affects the demand of money, or the price of money directly affects the demand of money. So you have to think of it this way. Money is a commodity. Capital is a commodity. And the price of money or capital is the interest rate. So if the price of something goes up, typically the demand for that thing goes down. See, think about it this way. If any item, an iPhone as an example, I'm just using this because my iPhone is right in front of me. If the iPhones suddenly go up from like whatever, $1,100, $1,200, $1,500 they cost to $5,000, there'd just be way less demands for iPhones, right? Versus, say, other products, as an example, where if the cost of that thing or the price of that thing goes down, the demand for it goes up. And a good case in point basically is that you can see that when the cost of money goes down, which is the interest rate, markets are termed as being more frothy, because now people can take, say, more money and go invest it, and the amount of money they have to pay every month, which is called their debt servicing cost, is way less. Very simple example. Let's just create this over here. I'm going to do some formatting here and just show you an example, right? So simple example. Think about it this way. We're just going to call this loan. So the loan we have over here, just to give you an example, right? Let's assume it is, what is it? $100,000, right? So I'm going to go here, make the formatting better, right? It's $100,000. So we're going to go scenario 1, 2, hold on, 3, right? And we say the interest rate. So we're just going to call this the interest rate. And this, how this is going to be, is in one scenario, the interest rate is say 2.5%. In one scenario, it's 4%. And then in one scenario, it's 8%, right? So think of this way. What is your debt servicing cost? You can also call this monthly cost, right? Let me actually just move this here. So monthly cost, right? Monthly interest cost, right? Let's write it like that. Or actually, let's call it annual interest cost, which will show you an even bigger number over here. So if you go out to the market and you get $100,000 loan at 2.5%, you just got to pay $2,500 a year for that loan, right? 100,000 multiplied by 2.5%, very simple math. But if the same loan now is at 4%, you're suddenly paying $4,000. And if the same loan is 8%, you are suddenly paying $8,000. And if you think about it, we have to look at it in terms of percentages increases, right? Not just the amount of money that you are paying out in this scenario, but what is the percentage increase in your debt servicing costs, right? So you go, in this case, it's 4,000 divided by 2,500, right? And we're going to anchor this to show you this number, right? This is a 2, 1, hold on, I go -1. This is a 60% increase in your annual debt servicing cost. Think about it this way. Pick your mortgage as an example, right? If the cost of your mortgage increases by 60% a year, I mean, that's going to cause a lot of friction in your household, and it's going to be pretty painful, right? Now, in this case, think about it. Money goes from 2.5 to 8%, right? Now, the same $100,000 where you were paying $2,500 a year earlier, you're paying $8,000, right? Now your cost has skyrocketed by 220%. I mean, that's no joke, guys. That is significant amount of money that you have to pay. I mean, just think of any expense that you have. If your costs go up by 220%, I mean, that's a big pain. And I'm on the other screen getting out a 1-month term SOFR, just chart history. I just want to show you guys something, right? Let me just paste this here. Our analysts were kind enough to pull this together. So don't worry about these lines at the top. We were just getting data from 10 October onwards. So don't worry about that. But look at this. We have the 1-month term SOFR, these 3 lines, blue, red, and yellow. 1-month term SOFR, 3-month term SOFR, and 1-month LIBOR. So let's use the blue line as an example. It went from, say, let's assume this number is about 1.75 to close to 3.5%. That's a 200% increase. In this case, it's like close to that, jump from 2.5 to 8%. Similarly, 3-month term SOFR goes from, say, 2.25 to 4%. Like, you go, let's do 4 divided by 2.25. Again, these are approximations. It's gone up by 177%. Similarly, this thing over here, which is 1-month term LIBOR, the yellow line, right? That goes from, say, let's assume it's 2.3% to about 4.3, 4.4%, right? So you go 4.3 divided by 2.3. Again, that's gone up by about close to 90%. So these are real world examples. And by the way, just to let you know, this is from July of this year to October of this year. So just in what, July, August, September, right? In 3 months, your interest rate costs have skyrocketed. They have gone up anywhere from, like, say, 75% all the way up to 200% in certain cases. So this is why you're hearing all this stuff about, say, the stock market going into a tailspin, because a lot of companies, think about it this way. You're a Fortune 500 company. You now want to go build a new factory. You want to buy more product. You want to buy more inventory. You want to do all of this stuff. Now it's going to cost you way more. So the amount of resources in this case that you were using to basically buy product, or inventory, or build a factory, hire more people, well, you have to do less of that, because more and more of the amount of money you have is going towards paying your debt servicing costs, right? The other thing over here also is this, what the Fed is doing here is intentional. Because inflation was so low, or perceived inflation was so low for so long, and then they came out with the opinion last year that inflation is transitory, that famous comment, and inflation has spiraled. The Fed, I think it's that Mark Twain saying, right? The Fed is like the guy with a hammer, because to a guy with a hammer, everything is a nail. And the Fed only controls one aspect of policy, which is the monetary policy, or in this case, they control what is basically the cost of money. Because if they jack up the cost of money, this means getting a loan is more expensive. This means more and more people will either not be able to pay their bills if they're leveraged, or they will not get loans because it's just not worth it. So what they're trying to do in this environment is to constrain basically demand indirectly via supply. And this is something that's very unique, because ever since post-World War II, when the Fed has really expanded its tentacles, what we have seen is a world where demand was the swing factor. Basically, supply was never an issue. Because anytime, think about it, at least in America, right? Think about it this way. Anytime you want to go get a car, the dealerships are filled with cars, right? Anytime you want to go to the grocery stores, there's no shortage of product. Well, we live in a very different world because of COVID and all the supply chain disruptions around it. What's happened now is there is ample demand. Apart from just this regular demand for product, the government also printed so much money that created so much demand. But because supply chain is at an issue, so now you have very scarce supply. So for the same amount of goods, think about it this way, right? You have, even if you have the same amount of demand, but you have very less goods available to satiate that demand. What's happening now is that is causing an upward spiral on pricing. And the other big fear that the Fed has is that this might become a case of 1970s where you had stagflation. And what was happening in that case particularly is, again, an oversimplification. You should read very articles about it, but an oversimplification of stagflation basically is that you have inflation. The prices of goods and services are going up, but you also have unemployment, because that is a big problem. Because what you now have is you don't have enough supply. The price of everything's going up. It's making the cost of living so onerous, the cost of borrowing so onerous, that employers, the employers or business people now have to lay off people. They can't hire, they can't expand enough. Think about it this way. You are the CEO of a company and you have all these great plans. You're going to build a factory and you're going to hire 100 people. And now those jobs are going to be created and all the jobs around them to cater to those jobs are going to be created. And suddenly, the cost of money goes up at such an alarming pace, right? And you have to now curtail or actually even eliminate all of those projects. What do you do now? Well, you can eliminate it, but you're obviously not the only one in the economy. Other people are also seeing this. They curtail their activities. And as a result, what happens is that the economy now, you have less employment in the economy. Your inflation is still rampant through the economy. And this has a lot of negative effects. So what the Fed is trying to do in this case is tackle this problem really, really, really aggressively up front, induce a recession in the hopes that by the time a recession comes, and again, they've changed the definition of the word recession, so we were already under a recession technically. What is now going to happen is demand is going to go down, which will then help supply to balance demand, or the supply chain to catch up with demand. This is why we're already seeing, for instance, retailers like Target, Walmart coming out in their earnings report and saying, look, we're overstocked now. Because, we were so fearful of our supply chains being an issue that we ordered too much inventory. And now we have too much inventory and nobody's buying the stuff at a quick enough pace. So we have to put even more discounts. So now they have to basically, take down the prices of their products. And what the Fed is now trying to do is indirectly affect demand to allow the supply chain to catch up, to get into what, in their terms, is a normalized world, whatever that means, but that's the thinking behind it. And this is why you see this inverted yield curve, right? This is the yield, because the cost of money is basically the yield you get. If you lend to somebody, say in 1027, 2022, and you just charge them the 1 month USD LIBOR forward curve, you charge 3.6%, right? And you see how quickly this goes from 3.6 to 4.24% practically overnight, right? The reason why you see this basically is because the market is expecting that the Fed meeting in early November, they're going to ratchet up the interest rate by 75 basis points. So they're trying to price in some of that. That's why you see this big jump, and then it's less of a jump and less of a jump and less of a jump, right? That's the big picture idea behind it. Now, how does this affect real estate sponsors, as an example? So I'm going to show you a very simple example. What we're going to basically do is that we are basically going to, let me actually set some formatting correctly, right? And I'm going to show you how this works, right? So what we're basically planning on doing is showing you how, with a loan amount, a theoretical loan amount, and this can be an editable worksheet, I'm going to share this, you can play around to see how does the interest rate affect you, and what can you do to mitigate rising interest rates. Because what you can do as a mitigation against rising interest rates is to buy a rate cap. So think about it this way, right? The market in this particular case, or this case, thinks, hey, this is the path of interest rates, right? But you feel, you're an astute manager, you're an astute investor, and you feel the market is being overly optimistic, as an example, right? Well, in this case, it's overly optimistic. It could also be the opposite. The market is being overly optimistic. And in fact, you feel rates are going to go up much higher than this. But you still want to be in a floating interest rate product because of many operational reasons. If you're a real estate person, if you're in a floating interest rate product, you have the ability to exit deals without onerous prepayment penalties. If you're in a fixed rate deal, even though in the short term it feels very mentally comforting, the problem becomes that in a fixed rate deal, it's very hard to exit these deals in 1 or 2 years' time, right? The reason is that the person who has lent you money, think about it in these terms, right? You have to really simplify and get down to the fundamentals, right? The person, say, who lends you money at, say, 6% a year for 10 years. In very simple terms, they are assuming that they are going to get a 6% return on their money for 10 years. They've already banked that income. They've baked it into their calculations, right? Now, a year from now, you come back when the rate suddenly drops, say from 6% to 5%, and you come back and you tell the person, hey, I'm just going to give you back your money because now I'm going to go to the open market and get a cheaper rate. Well, now this person is, quote unquote, losing future income streams, right? Future cash flows. So they have to be compensated for the loss of future income, right? That's why fixed rate products, it's like Hotel California. You can check in anytime you like, but you can never, ever leave. So, but again, there's a room and a place for fixed rate product. You have to match it with your business plan. Most syndicators typically, they underwrite to a 5-year holding period, but we're trying to get out in years 2, 3, 4, somewhere along this line, maybe even year 1. That's rarer. So you want to have operational flexibility, right? And you can't have operational flexibility because there is, with every product, there are pros and cons. There is no product where you're only going to get the benefit and your counterparty isn't going to get any benefit. So you have to weigh the pros and cons. But in this context, as an example, if you feel the market is being overly optimistic, and in fact, rates are going to go up way more than this. They're just going to go up to 10%, 12%, whatever you feel is the case, right? Well, you can buy an insurance product. It's called a rate cap. And what the rate cap says is that, at or above a certain point, if rates go above a certain point, right, you are not going to be paying for that. You have a counterparty from who you buy this insurance product, similar to an insurance company. They will pay you the differential. So as an example, and we'll get to this, very simple example. If you say, buy a rate cap and the calculation becomes 6%, and now the rates go to 7%, well, the difference between 6 and 7%, which is 1%, that cost, that is going to be borne by the rate cap provider, right? So this is why you can buy rate caps if you feel, for instance, the market is being overly optimistic or you have a different view. Conversely, for instance, you feel that, in fact, the market is saying this and the market is thinking the sky is going to fall because the market is being overly pessimistic, but you feel maybe in the next year, rates are going to come down way much. So as an example, by 1027, this reference is not going to be 482. It might be 282. That's what your opinion is, right? Well, then you might decide it's no use to buy a rate cap, or you don't have to pay that much cost of a rate cap, because you have to understand, in a very tumultuous time like right now, where there's so much uncertainty, the person or counterparty that's providing you the rate cap, they're going to charge a pretty penny for their services, right? Because they know you're in a bind. It's a bit like, somebody with a poor driving record, right? If they try to get an insurance, the insurance provider is going to charge them a lot of money. Or somebody in poor health, most insurers won't even insure somebody like that. And if they do, it's just going to cost that person an arm and a leg. So in this particular case, you have to decide as an astute investor and sponsor, okay, where do I lie? How do these things happen? So this is why it's very important to understand both the science about how it happens, which we're going to discuss over here, but also the art of how these things happen. And this is why, as sponsors and investors, we have to take an opinion of the future. And this is why understanding the mechanics of how these things work becomes very important. So I'm going to show you now how are rate caps actually calculated and what's the mechanics behind it, right? So think about it this way. We have a loan amount, right? We're just going to call this, we're going to make some pretty formatting here. This is going to be $20 million, right? So anything that's an input, it's light yellow with blue text, right? We have an interest rate strike rate, right? This is basically, and I'm going to get into this, this is basically the strike rate that you have based on the insurance that you're buying, right? This says that, hey, if the reference rate goes above a certain rate and we're going to input this value, then your counterparty is going to pay you for this, right? So in this case, we're going to just use, say, I don't know, 3% as an example, right? Let's make it 3%. Then we have what is the cost. Now, anytime you're going to do this, there's going to be a cost associated with this as well. So what is the interest rate cap cost, as an example? Let me go do it like this, right? What is the cap cost around it? How are all of these things done? Let me also make this Calibri because I kind of like that font, right? 11, this is a good size. So what is the cost for this thing, right? Let's assume we say the cost for this thing is $800,000, right? So for a $20 million loan at a strike rate of 3%, you're expected to come out of pocket $800,000. These are all assumptions. It could be a different thing. You know, we're just using this. And we are going to say, what is the spread? Now, this is what I was talking about, right? We're going to assume it's 2.5%. The spread basically means that, look, we talked about the reference rate over here, right? But this is basically a theoretical reference rate. Now, if think about it this way, you know, if Bill Gates goes to get a loan, Bill Gates is worth whatever hundreds of billions of dollars is worth, right? If a banker is looking at Bill Gates versus looking at somebody who's poorer than Bill Gates, which is pretty much everybody else like us, right? Who do you think they're going to give a loan out to? Or who do you think they prefer to give a loan out to? They would prefer to give a loan out to Bill Gates because he's just rich. He's got more money in case things go south. He's got money to pay back that loan, right? So Bill Gates is less of a risk than, say, pretty much anybody else who's not Bill Gates, right? So in this case, a banker might say, hey, you know, the forward curve is 3.6%. I am going to charge Bill Gates 100 basis points or 1% spread on top of the forward curve. So in 1027, 100 basis points or 1% would be 4.6. In 1128, it would be 5.24 and so on. But person X, who is not Bill Gates, they will be charged 2.5% on top of the floating rate. That's the spread a lender is charging to account for the riskiness of, say, the borrower, right? So we're just going to assume it's 2.5%. It could be any number. It's an input. You can add whatever number you want, right? Now we're going to set up a table. And the reason why I'm set up a table is because this is now going to show you how these things work, right? So we're going to say month 1, and we are going to call this, you know, let's just go down like this, right? +1. We're going to go all the way down to say, oh, no, I shouldn't have done that. Yeah, we're going to go all the way down to say 24 months. You can get this 3 months, years into the future, 2 years into the future, 5 years into the future. I'm just going to use a 2-year point, just to give you an idea, right? We're going to type date here. Let's do the pretty formatting because, you know, formatting is very important in life. So we are now, what we're now going to do is we are going to go here. We're going to equal to, we're going to go to this date, right? This date is kind of important to us, right? So we say, hey, we're starting off today. We're going to look at this date. How are we going to do this? We're just going to start here, and we are going to start going down all the way to 24 months out in the future, right? We start at 1027 and at 927. These are 24 periods, right? So what we're also going to do is we're going to say, hey, what is the 1 month LIBOR curve over here? So let me do this. Let me hide all of this stuff, right? So we just look at one thing. What is the 1 month USD LIBOR? It could be SOFR, it could be LIBOR, you name it. It's the 1 month USD LIBOR. And let's expand this just so that we kind of know what this means, right? So it's going to be 1 month USD LIBOR. I'm going to expand this little column over here, right? So let's go like this. I just want to know my, yeah, let's make it go like this, right? What, and I'm going to go here. So 1027, this is basically, now I'm going to format it properly. So give me 1 second. I am going to format this correctly. So now we're going to start running our numbers. So it starts at say 3.6, 9/27/2024. We're just going to copy paste the formula down. We go like this. Here you go, right? Just check this. 9/27/2024 is 3.92. 923.92. So we're doing the math. So far we're doing this correctly, right? Now we go down. What is the interest rate cap or strike rate, right? Interest rate cap strike rate, right? Now, as we said above, this is basically the strike rate in this case. And don't worry, I'm going to tell you how this works, but we're just going to assume this is always going to be the strike rate, right? Now we're going to see what is the actual reference rate, right? Let me actually make this. I know this sounds kind of finicky. Let me make all of these things look good. So what does this mean over here? What this means over here is that anytime the rate is above 3%, our counterparty is going to pay, right? So we bought a rate, it's called a tight rate cap, which means it's much tighter. A wider rate cap, we're going to get to it, is the exact opposite. So we say anytime this US LIBOR forward curve is above 3%, our counterparty is going to pay for it. Now you would think, hey, Omar, if we know our first month is 3.6 and it goes all the way down, what type of person would even give you a rate cap? And that's a pretty good question. The reason why, or why would they even give you a rate cap? And the reason why they'd give you a rate cap is because you're paying them $800,000. So let's assume that's the calculation they've done for the price that they have. So they assume and they say, look, it's in our interest that if we get $800,000 up front, it compensates us for the cost of this thing, right? So what is the actual reference rate? The actual reference rate basically is going to be, we're going to be like, if this is a basic conditional formatting, right? If this number is this, then, hold on, let me just look at it. This would basically be this. So we're just going to say they take the minimum of this and this, right? Whatever is the minimum value, that becomes the interest rate, right? The reference rate. Why the minimum value? Because, as I said, if anything is above 3%, then we're only paying 3%, and whoever else is left, they are paying 3.6%. Got it? Now let me reduce these columns because I might want to show a few more things. Right over here, now we have the spread. Now this tells us, we said the spread over here is 2.5%. This is the measure of riskiness, right? Like I said, Bill Gates might get it at 1%, and you and I are getting it at 2.5%, right? Just because I don't have $100 billion yet. So that's why, right? Now we're going to find out what is the actual interest rate that we are going to be charged for this month. And that is simply the sum of the reference rate plus the spread. There you go. Boom. We basically have found a way, even though that we bought a floating rate product, we found a way to fix our interest rate in a way. It's called synthetically fixing your ceiling of your interest rate, right? So our interest rate is 5.5%, even though we have a floating rate product. And magically, if we ever want to exit the deal, we have to pay very less penalties to exit the deal versus somebody who got say a 5.5% fixed rate product. But if they want to exit the deal in 1 or 2 years, they're going to have to pay so much more prepayment penalties. So magically, even though our interest rate is the same, we now have more flexibility in this scenario, right? So what is the monthly interest cost, right? Let's do this. So we'll go 5.5% divided by 12, because we want to find the monthly, times $20 million, right? We anchor it, Now we know basically that every month in this particular scenario, based on this in strike rate and this spread, our cost is going to be, our monthly debt servicing cost is going to be this much, right? So let's just do a check. Year 1, year 2, how much are these costs going to cost us? Total and error check. Always good to have an error check, okay? So what is the sum of, say, 12, right? How much interest cost do we charge in month 12, right? It's 1,100, 1.1 million. Let's go from period 13 all the way down. Then we go all of this for all this. This is just a means for us to say check our work. We checked it. Boom, we did this correctly. So in year one, in this particular scenario, we're paying $1.1 million. Year two, we're paying $1.1 million. And our total interest over 2 years in this particular scenario is $2.2 million. And we checked our work and we made sure it's correct. So let's name this and call this the 3.00% strike rate. Yeah, I need to know how to spell strike rate. Strike rate scenario, right? Now let's experiment with a different strike rate. You think, hey, the cost of $800,000, man, that's really steep. And I don't personally, let's assume you feel that, hey, man, I don't necessarily think this, I can't really afford this cost, and I feel the future is going to be a little bit different, or I feel the deal that I have is such a screamer of a deal. We've got such a good deal because we're great negotiators that our deal will be able to withstand and pay for higher debt servicing costs because we just got a great deal. So you say, you know what, instead of say 3%, I'm going to go 4% strike rate, right? So you get a 4% strike rate over here. So what does this mean? Your strike rate becomes 4. So this means you're actually paying, as an example, when USD LIBOR is 3.6%, you're paying 3.6%. And basically your spread is 2.5%, right? So your rate becomes 6.1 in this case, right? So if you think about it this way, here it was 5.5. You don't really want to pay that cost. It's 6%, but just wait a sec. Because you have a strike rate of 4%, this cost might be 500,000. Now there's some bond math and math behind it. I don't want to get into the detail. Let's assume it's an input, right? Let's just assume that there is some math that goes behind this thing. I'm not going to get into the details of that. So right now, if you think about it, just say in this month one, you were paying in the earlier scenario, a 3% strike rate. You or this hypothetical investor sponsor was paying 5.5% interest rate, and which is the monthly interest rate cost is $91,667. In this case, we have a 4.0% strike rate, and the cost jumps up from 91,667 to 101,607. So if you can see it in year one, we're going to pay 1.293 million in interest costs, but in the earlier 3% scenario, we are only paying $1.1 million, right? So you're okay with that. And if you go down, you see, look, the most your interest rate cost per month goes up to is 6.5 million. And then at the tail end of this, when, the USD LIBOR says, as of right now, hey, your rate is going to dip below 4%. Now you're paying less money, right? So you kind of get this idea. Now we're going to do one more scenario here, right? You say, you know what? This cost is too expensive, or I feel I haven't even, there could be multitude of reasons, right? But you feel, you know what, I am willing to take the risk of going unhedged. I do not want to hedge my position. I feel I have the greatest deal in the world. Bill Gates literally is, one of my backers, and he's told me, hey, you know what, I do not want you to hedge. If there's any financial issues, Bill Gates is going to write me a check, right? Or Elon Musk, or choose your favorite billionaire. They're going to write me a check. We're going to come completely unhedged. So you say, okay, there is no strike rate. There is no cap cost, right? So in this scenario, sorry, my formula should be better. This should basically be this. So basically this is what your position becomes in this scenario. Sorry, I should have written a better, more cooler formula, but you understand. See, there is no strike rate over here. So now you see your interest rate is basically all over the place because this is an unhedged position. We're going to write this unhedged, right? Which means you didn't buy a strike rate. You don't have a strike rate because you didn't buy a rate cap. You didn't pay any money. So you pocketed this $500,000 or $800,000 because you got a really rich uncle, or, Bill Gates or Elon Musk. And they're like, don't worry about it. You've got the best deal in the world. Back yourself up. Go for the kill. Right? So in this case, you see year one, you're now paying, instead of paying 1.1 million in the 3% strike rate, or in the 4% strike rate, 1.293 million, you are now paying $1.462 million. And your year two, there's a little bit of a change, and your total interest costs in this unhedged scenario are 2.8 million. In the 4% case, it was 2.59 million. And in the 3% case, it's 2.2 million, right? So let's kind of draw up a little summary sheet over here that can hopefully give us a little bit of an idea about how to basically how to look at these options, right? Because a lot of us astute sponsors, that's literally what we're doing when we're buying these deals under these scenarios, right? So what we're going to do here is we're going to call this year one interest, right? Year two interest. We're going to bold this and make it wrap text. Formatting is always important. All my team members know how much I harp about formatting. We're going to make this a what is this thing called, like a higher indent or whatever it is. What is the cap rate cost? What is the difference in total interest rate, right? This is what we're going to do. So we go, and this is our scenarios over here, right? So we have a 3.0% strike rate. I don't know why I don't want to spell strike rate. Strike rate, we have a 4.0% strike rate and an unhedged position, right? So we go year one. We just want to look at it as a table. We want to make our life easy, right? Year one is this. Year two is this. The total interest rate is this. Cap cost is this, right? 4% scenario over here. Year one is this. Year two is this. And year three, and total is this. And your cap costs are, hold on, I think I screwed up there. Yeah, your cap costs are $500,000, right? And now we're going to do the same thing on a hedge. I'm just linking everything. So it's in one spot. We can see it easily, right? All the hard work we've done, we can see it basically in a grid-like format because it's easy for us to analyze, right? No cost here, but I'm still going to link it in case you want to put something there, right? So in this particular scenario, let me actually do this. Let me actually move this column there. I'm going to cut and paste over here just so that we can see what's going on. So let's assume we just want to look at total interest rates. We're going to use this as our base scenario, right? And then we're going to compare everything. We're going to compare the 4% strike rate and unhedged to our base scenario, which is basically the 3% strike rate. So we say, look, we have total interest costs of 2.591 million, negative 2.2 million, right? We're going to anchor this. So in this scenario of the 4% strike rate, we're going to end up paying $391,000 more in interest rate costs over 2 years, right? And drag the formula down. Now this compares to 2.8 to 2.2. And wow, we're going to pay $631,000 across 2 years. We can do the same thing, difference in year one interest, right? Do the exact same thing. Go 1293 minus 1.1 anchored, right? So in year one, as an example, if we had a 3% strike rate, if we bought a rate cap at a 3% strike rate, and that's our base case scenario, but now we buy it at a 4% strike rate, we're going to end up paying $193,000 more in year one versus our base case scenario of 3% strike rate. But if we went totally unhedged, we were totally naked, we would end up paying $362,836 more, right? I'm going to highlight this as a, let's use like some nice pastel colors here, right? We're going to do difference in year two interest. I'm going to use a different color here just for ease of reference, right? Going to use a nice green, going to use the same formula. In year two, we're just going to compare our costs. We're going to pay $197,999, basically $198,000 more in the 4% strike rate versus the 3% strike rate, and in the unhedged position versus the 3% strike rate. We're going to pay $268,417 more, right? I'm going to use a different highlight over here. So this way you can basically see how much more interest you're going to pay in your debt servicing costs versus, say, whatever base case scenario you've chosen. We chose the 3% strike rate. What is your cap rate? And when you take all of these things into account, now what starts happening is you start understanding, okay, what are my various options? You compare it to the deal that you have, the business plan that you have, the market that you're in, and the loan that you have to understand, okay, how should I start looking at hedging my position, right? Do I want to take a position? Do I not want to take a position? Do I want to be more conservative? Do I want to be less conservative, right? Because sometimes it pays to be conservative, but sometimes it hurts to be too conservative, and vice versa. Sometimes it pays to be aggressive. Oftentimes it doesn't pay to be very aggressive. So you always have to make that decision, and you have to do it in a mathematical way, because if you don't do it in a mathematical way, the problem becomes basically that issues start happening, right? If you don't understand your business, you don't understand the mechanics of each component in your business, it's going to make for a lot of painful conversations that you're going to have with your investors, with your partners, and all of that. So when you go in, when you have knowledge, you understand how the various components work, you can get ahead of emerging problems before they even happen. Or if you're in trouble, you understand what your options are, and you can then reduce your risk in a deal, go with a risk minimization framework. So I hope this was helpful. If you've got any questions, you should basically reach out to our team. You can also, and I'm going to put on my glasses because now you know I'm intelligent, I'm going to tell you, what you should also do is join my mailing list by visiting our website at boardwalkwealth.com. The form is right on our homepage. And if you join now, by the way, I'll also give you access to my hidden mobile app, which has over 9 hours of free passive investing courses. Again, that's at boardwalkwealth.com. I hope this was helpful. I hope you're more informed, and I hope you're more educated and can take better, more astute investing decisions.